Welcome back to The Deep Dive. Today, we're looking at a market that feels, well, completely split. It's not just one story in the intelligence we've gathered.
No, it really isn't. It's like watching two different channels at once.
Exactly, a perfect split screen. On one side, you've got this immediate, visceral fear in the price action, you know, liquidations, technical charts looking ugly, real pain for anyone leveraged.
Yeah, the short-term picture is definitely stressful if you're watching the ticker.
But then on the other screen, you have these foundational shifts happening, massive infrastructure deals, global regulators getting serious and coordinated, stuff that screams long-term strength.
That's the core finding, really.
Yeah.
What we're seeing looks like a tactical retreat, a short-term pullback happening within a much larger strategic advance.
Okay.
The news flow, the fundamental news, has actually been incredibly constructive for the long haul. It's just that right now, the leveraged traders are the ones getting squeezed.
All right, let's dive into that tactical retreat first, because that's what hits the headlines. That's what people are feeling right now.
Makes sense.
The weekend rally, which almost touched $111,000, poof, gone.
Yeah, completely erased.
We saw Bitcoin dip below $108,000. That's what, about a 2.3% to maybe 3.5% drop in 24 hours?
Roughly, yes. And it wasn't just Bitcoin feeling the heat.
No, it dragged the whole market down. Major altcoins fell 4 to 6%. Felt like a classic market-wide de-risking.
And there was a very specific technical reason for that accelerated slide.
Okay, what was the trigger?
The price broke below its 200-day moving average. That's a big one for technical traders.
Right, that long-term trend line, where was that sitting? Around 109K?
Pretty much, yeah, near $109,000.
Yeah.
When it failed to hold that level, well, technically, that shifts the medium-term trend outlook to bearish.
Yeah.
Purely based on the charts.
And the fallout from that break, was it mostly hitting the derivatives guys, the leverage bets?
Oh, absolutely. You can pinpoint the pain there. The consequence was immediate and, frankly, brutal for leveraged longs. That technical breakdown triggered a massive wave of forced liquidations. We saw over $420 million. And some sources are now saying that number might be closer to $536 million.
Wow.
In leveraged long positions just wiped out, automatically closed by exchanges.
And that just pours fuel on the fire, right? Forces the price down even faster.
Exactly. It accelerates the sell-off way beyond what simple spot selling would do. It becomes this kind of mechanical cascade downwards.
And then piling on top of that technical pressure, you get the narratives. Peter Brandt, the veteran trader, comes out and says he's shorting it.
Right. He publicly disclosed a short position, which definitely adds to the bearish sentiment, gives other traders cover.
What's his reasoning? Based on a chart pattern.
Yeah, it's a classic technical pattern he's citing. It's called the megaphone, or sometimes the broadening top pattern on the daily chart.
Okay, what does that usually signal?
Well, the pattern shows these widening price swings, so higher highs, but also lower lows. It often suggests the market's losing direction, volatility is increasing, and it could be forming a top before a potentially significant decline.
And he threw in a pretty dramatic historical comparison too, didn't he?
He did. Get your attention.
Yeah.
He compared this pattern to one he saw in the 1977 soybean market.
Soybeans, okay.
Yeah. Apparently that pattern preceded a massive, 50% collapse in soybean prices back then.
Okay, so that definitely adds a layer of historical fear, let's call it.
It does. So you see the negative feedback loop, technical breakdown below the 200-day, massive forced liquidations amplifying the drop, and then a respected voice like Brandt reinforcing the bearish view with a scary historical parallel. It's a tough mix for short-term sentiment.
All right, so that explains the mechanics of the drop, the how. But let's diagnose the why. Is this actual panic selling, or is it more like the buyers just disappeared? A demand issue.
That's the key question.
Yeah.
And looking at the capital flows from the week leading up to this really sets the stage.
Let's look at the institutional side then, the spot ETFs.
Exactly. That's been such a huge source of buying pressure this whole cycle, right?
Definitely.
Well, they saw a major reversal. Over 3 days, October 29th, 30th, 31st, the U.S. spot Bitcoin ETFs recorded net outflows totaling about $799 million.
Almost $800 million out. Okay, that's significant. That definitely removes a big buyer from the market.
It removes a massive pillar of support. When that institutional bid disappears, even temporarily, the market becomes much more vulnerable to selling pressure, even if it's not panic selling.
But, okay, if we dig into the on-chain data, the picture gets well, complicated. It shows a big difference between the average holder and maybe the newer entrants.
That's the fascinating divergence. The core holder base looks incredibly strong.
How so?
The data shows the average Bitcoin holder's cost basis, like the average price they paid, is way down around $55,900.
55.9. Okay, so even with the price dropping below 108K.
They're still sitting on massive unrealized gains, on average about 93% profit.
93%. So no reason for the average long-term holder to panic sell. They're deep in the green.
Exactly. There's no systemic crisis of conviction there. The hodlers are holding.
So why didn't they step in and buy this dip, absorb the selling? If they're so profitable, why let the price fall?
That's the million-dollar question, isn't it? It seems the weakness isn't with the long-term holders, it's with the newer crowd. The short-term holders, or STHs.
Okay, what's their situation?
Their average cost basis is much, much higher. It's estimated to be around $113,000.
Okay. So with the price now below 108K.
That whole cohort of recent buyers is now underwater. Their positions are in the red.
And they are the ones more likely to sell, maybe to cut losses or just get back to even.
Precisely. They represent the immediate selling pressure, the weak hands in this scenario. The market couldn't hold above their entry point, increasing the odds they'd fold.
And we did see significant selling from larger players too, right? It wasn't just small retail.
That's right. Analysis showed that large wallet holders, the so-called whales, offloaded roughly $600 million worth of Bitcoin over the weekend.
So sophisticated entities taking profits, adding to that supply overhang.
Correct. It confirms the pressure is coming from profit-taking and likely some de-risking from bigger players hitting the market just as that institutional ETF demand paused.
So putting it all together, the problem isn't really a mass panic, like everyone rushing for the exits.
Doesn't look like it. It's more accurately described as a demand vacuum.
Oh, demand vacuum. Okay.
Strong hands are holding tight, sitting on big profits. But the reason buyers are underwater and the big institutional inflow via ETFs hit pause, that allowed methodical profit-taking and the forced deleveraging to push prices down without strong bids to absorb it.
Okay, that paints a much clearer picture of this tactical retreat. Now, let's flip that split screen. Let's talk about the strategic advance. Because while all this price drama unfolds, some huge foundational stuff is happening.
Absolutely huge. And it starts with this AI infrastructure pivot in the mining sector. This is where the narrative gets really bullish long-term.
Yeah, the cipher mining news was pretty staggering. What was the ticker again? CIFR.
CIFR, that's the one. They announced a truly landmark deal, a $5.5 billion 15-year lease agreement with Amazon Web Services, AWS.
$5.5 billion over 15 years with Amazon. I mean, it's not just a mining company deal anymore, is it?
Not at all. It's a fundamental re-rating signal for the entire sector, potentially.
What exactly is Cipher providing to AWS for that kind of money?
They're providing 300 megawatts MW of data center capacity. Critically, this includes both air and liquid cooling infrastructure, specifically designed for high-intensity AI workloads.
AI workloads, not Bitcoin mining.
Exactly. The rent payments, denominated in fiat, start in August 2026. This is the ultimate validation of what some have called the AI pivot, or the great decoupling thesis.
Explain that thesis a bit more.
The argument is that the real long-term value of these Bitcoin mining companies isn't just their mining rigs, which face diminishing returns due to the halving.
Right, and increasing global competition.
But rather their massive established power infrastructure, their ability to secure huge amounts of energy, build out data centers, manage heat loads efficiently, that's incredibly valuable for other high-demand computing needs, especially AI.
So this deal basically proves that thesis.
Absolutely. It creates a stable, long-term revenue stream for Cipher, paid in fiat dollars, completely independent of Bitcoin's price volatility and the halving cycle.
It insulates their business model, transforms them from a pure crypto play
into an essential digital infrastructure provider, servicing one of the biggest tech companies on the planet. That's a different class of asset entirely.
And this isn't just a one-off, right? Other miners are signaling similar moves.
Definitely seems to be an industry trend. We saw reports mentioning Kango Inc. and NIP Group also emphasizing value capture from energy and AI in their strategic outlooks.
Yeah, I saw NIP Group framed their recent mining expansion. They're up to 11.3 exahashes per second now explicitly as part of their broader digital infrastructure strategy.
It all points in the same direction. The market is recognizing that these companies' core assets, the power agreements, the physical locations, the cooling tech, might be more valuable serving the exploding demand for AI compute than just mining Bitcoin. The AWS deal is the big proof point.
A real potential decoupling from Bitcoin's price for their valuations. Fascinating. Okay, let's shift from physical infrastructure to regulatory infrastructure. That's another key part, the strategic advance story.
Yes, and things are accelerating globally there, too. Competition is heating up among jurisdictions to build regulated institutional-grade markets.
What's happening in Europe?
Well, building on their MiCA framework, the European Commission is now planning legislation to create a single pan-European supervisor for crypto exchanges.
Centralizing oversight.
Exactly. Possibly by expanding the powers of ESMA, their main securities regulator. The goal is to move beyond just having rules, MiCA, to having unified enforcement across all 27 EU member states.
Kind of like the SEC model in the US.
That seems to be the model, yeah. They want to create a single competitive capital markets union for digital assets, making the EU bloc more attractive for global institutional players.
And meanwhile, halfway across the world, Hong Kong is making moves too, focused more on liquidity.
That's right. Hong Kong's Securities and Futures Commission, the SFC, just announced a significant change. They're now allowing their licensed virtual asset platforms, the regulated exchanges, to connect with their global affiliate platforms.
What does that connection allow them to do?
Crucially, it allows them to share order books and tap into global liquidity pools.
Ah, okay. That tackles the problem of shallow liquidity, right? Where big trades move the price too much in a closed-off market.
Precisely. By allowing access to deeper global liquidity, they can offer better pricing, tighter spreads, and more reliable execution for large institutional trades. It makes Hong Kong a much more viable hub for serious capital.
So both Europe and Hong Kong are taking clear competitive steps to build out attractive, regulated environments.
Absolutely. They see the writing on the wall. The era of regulatory uncertainty is fading, and the race is on to become the preferred jurisdiction for institutional crypto activity. This is foundational infrastructure being built at the policy level.
And while regulators build frameworks, some institutions just keep building their stacks.
Yeah.
Strategy Inc. bought more Bitcoin.
They did. Another purchase, an additional 397 BTC for about $45.6 million.
It just reinforces that split screen again, doesn't it? The short-term traders are de-risking, liquidating.
While the long-term corporate builders, the ones integrating this into their strategy, just continue to accumulate, almost ignoring the short-term noise.
It's this constant tension between the trader view and the builder view.
And history tends to favor the builders. The volatility comes from the derivatives markets, the ETF flows pausing, but the adoption, the integration, that's driven by these corporate moves and the regulatory clarity we're seeing emerge globally.
Okay, so summing it all up, it's this wild contrast. Technical breakdown, huge liquidations causing immediate fear, but underneath, multi-billion-dollar AI deals, re-rating miners, and global regulators racing to build stable markets.
A real market schizophrenia, as you said.
So where does that leave us right now? What should we be watching immediately to see if this tactical retreat is ending or if there's more pain ahead?
Yeah, the market's definitely in a show-me state. The bullish long-term story needs to demonstrate it can absorb this short-term selling pressure. There are three key things to watch right now.
Okay, number one.
First, the immediate defense of the $106,000 support level. That seems to be the next critical line in the sand. If Bitcoin starts closing daily candles below 106K, it suggests that technical damage is worsening and could open the door to the $100,000 to $102,000 zone.
So hold 106K. Got it. What's number two?
Second, we absolutely need to see a reversal in those U.S. spot ETF flows. That $799 million outflow needs to stop bleeding and ideally flip back to neutral or, better yet, positive net inflows.
That would signal the institutional buyers are stepping back in.
Exactly. It shows that marginal buyer is returning to absorb the supply coming from profit takers or nervous short-term holders.
Okay, and the third thing to watch.
Keep a close eye on the derivatives market, specifically open interest. That's the total number of outstanding futures and options contracts.
What are we looking for there?
Ideally, you'd want to see open interest decline without the price collapsing further. That would be a constructive sign.
Meaning?
It would suggest that the excess speculative leverage, the really risky bets that caused those liquidations, has been flushed out of the system. That would pave the way for a healthier, more sustainable recovery, potentially driven by actual spot buying, not just leverage.
Defend 106K, watch ETF flows turn positive, and see if open interest drops without price cratering. Clear signals.
It's a really fascinating moment. You've got these incredibly strong fundamental tailwinds picking up speed just as the short-term price action turns quite ugly.
Definitely.
So maybe a provocative thought to leave you with. Thinking about that huge Cypher and Amazon deal.
Okay.
Has the Bitcoin mining industry now essentially irrevocably split. Given that $5.5 billion 15-year contract, are we going to see a permanent bifurcation?
Meaning some miners become valued differently?
Yeah. Will the market start valuing companies like Cypher, the one successfully pivoting to serve high-value AI workloads with guaranteed fiat revenue, less on the volatile price of Bitcoin, and more on their proven capacity as essential grid-scale digital infrastructure providers? Is
Hmm.
that the real decoupling to watch?
Valued like utilities or data center REITs almost, rather than just crypto proxies. That's definitely something to chew on as we see how this tactical retreat plays out.